Okay, so now continuing on here, now we want to look at the relationship between yield to maturity on a bond and what its price is when we look at it in the market. So let's just look at a simple kind of example here. One where we have a coupon bond. So remember, in the case of the coupon bond, I'm given these payments over time. Let's say I have a 6% interest rate, a future value of $1,000, and that the payments are made over the course of 5 years. So, what that would mean is that if I wanted to price out that bond, that $1,000 um, face value bond, how much should be paid for it, we would need to um, essentially sum up the present value of these payments that are received. Is it going to do it for us here or not? It does not. Okay, so let's just go back here. Sorry, I thought it was going to do it for us here. Essentially, then we would put in, I'm not sure why they don't do it here, but you would essentially put in the 0.06. Sorry, my computer is also uploading the part 1 video here. So it'd be 1 plus 0.06, 60 divided by that. Then 60 divided by 1 plus 0.06 squared, cubed, right? And so on and so forth for the entire time period. With the very last year, because here in year 5, I'm receiving the 5th interest payment, and I'm receiving the $1,000. The yield to maturity, as opposed to the yield to maturity bond price. In our yield to maturity, what we'd be looking at here is looking at what is that interest rate that's going to make the present value of an asset be equal to that asset price of today. So what would the interest rate have to be to make the two equal? So we basically would have to solve for the unknown. So if I had a $10,000 loan and I was required to pay $11,000 in year 1, well, then essentially, right, we could break that down and we could kind of solve for, in this kind of simple math that's presented to us here, we could see that this is 10% higher. And so we would know that this is a 10% interest rate. Where then I'm subtracting the future value minus the present value over the present value, or new minus old over old, which is our kind of general equation that we have for calculating percentage changes, new minus old over old. You could also, if you don't like to do, if this kind of calculation doesn't make, if it bothers you, you could also just go into a simple percentage change calculator that even Google has, and you could find the percentage change here, because we're going from 10,000 to 11,000, and it would tell you that's a 10% change. Okay, then we have our discount bonds. And again, these are the discount bonds are where I'm paid this $10,000. This $10,000 1-year discount bond has a value today of $9,200. What would that have to presume that the implied interest rate is behind it? Well, in this case, right, we're solving for the fact that the value today is $9,200 equal to the future value, which is $10,000, over 1 plus I. Notice how we're using here just the same calculations here, present value and future value, to basically solve for the unknown, which is why I say to my kids, that algebra is probably the most useful skill you will learn in almost all of high school, and that those who do well in algebra will be relatively mathematically stable for the rest of their lives, whereas those who are not will either suffer or they should at least marry or hang out with someone that is very good at algebra. Because all we're doing here is solving for the unknown. Here I'm just solving for the interest rate, which in this case would be 8.7%. Or we could rearrange the terms, right? And our interest rate would basically equal my future value minus my future value, or the face value of the bond, minus the price it's being sold for over the price, or the present value. It's essentially the same thing. In my fixed payment loan here, another way to think about it would be is that for a fixed payment loan, and we kind of see this with car payments, we see this a lot. What I'm looking at here is the fact that I'm getting a loan for this thing. Let's say that it's a $100,000 car. It must be a nice car. Right? And they would say, you can get this $100,000 car, and it's only going to cost you $12,000 a year for the next 20 years. Right? And people would do it because they'd be like, dude, I'm not $100,000. Just pay $12,000 a year for the next 20 years. Obviously, this is going to add up to more than $1,000. How much does it add up to? Well, right, we would sum that across here. But we would want to take the present value of all these payments to know what it's actually worth. I'm not going to solve it. These lectures are going to get very long otherwise. And then we have perpetuities. Perpetuities are things where basically the payment never stops. It's the coupon or the time period is infinite. And so when that's the case, essentially, then we just divide the price of the coupon bond by the interest rate. So in this case here, the coupon, which paying out $25 over the price of what we have here, right? So we could just rearrange the terms such that we could get a 5% interest rate, backwards solving, because basically we'd have two knowns and one unknown. And we could solve these things. I don't want to go through it. You can see this. You can ask me to do it, but I'm hoping that if you do have problems, you'll reach out to me, and I can even make you separate standalone videos where I go through the math that's required here. I'm just trying to keep my lecture somewhat down in length, at least for this part. Okay, but you can kind of see here, we've got a $500,000 simple business loan, and it requires you to, in 4 years from now, pay $700,000. How would you calculate that yield to maturity? And essentially, it's set up this way, right? And then again, we could go through kind of all the math here. Okay. Now, this becomes a pretty important topic here, is looking at this inverse relationship that exists between bond prices and bond yields. With the question being is, what happens to bond prices when the interest rate changes? Well, what we see is that if new bonds are being issued at a higher interest rate, then the existing bonds are going to have to adjust their prices. How are they going to change? Well, they're going to go down. I told you this earlier example, right? I bought this bond from the school district of Philadelphia, and I bought it in 2008, September of 2008, when interest rates were lower than they are today. So what is the value of that bond? If I were to try to sell that bond right now, it's not what I paid for it back then. Now, again, of course, I've been getting the interest payments since 2008. And when the bond does mature, the bond price really isn't going to matter to me because I'm just going to get my principal back. But if I were going to try to sell my bond right now before it matures, the bond price then does matter to me. And it's going to be determined by what it's competing against, which would be bonds that are paying a much higher interest rate as exists today. Obviously, if the price of the asset, right, if I were to try to buy a bond right now, I could get a really high interest rate, and presumably in the future, interest rates will hopefully fall, which would then mean that my bond that I bought today will be more valuable, which would mean I'd generate a capital gain. Otherwise, you've got a bond like I own that's from 2008, which right now has a capital loss because the price of the bond is lower. But again, does it matter to me? No, because I'll probably hold on to the bond until maturity. So bond prices then don't really matter. And it's exactly what we see right here, right? Scheiding's example is just like other banks, right? Banks, how did they get into the problem that they had? I guess would be one way of looking at it. How did the 2007 2009 crisis happen? Well, essentially, the interest rates starting in 2005 started to go up. Ben Bernanke, as I indicated in the previous lecture, interest rates started to increase in 2005 because Ben Bernanke, at the time the Federal Reserve Chairman, was concerned about a housing bubble existing. So he started to raise interest rates, which meant that banks that were holding on to all these bonds found themselves not only with greater default risk, but also greater interest rate risk. And so then they had these huge capital losses because people were also defaulting on their homes, but also now they owned an asset that had, they owned an asset from, like, let's say, loans that they issued in 2004, 2005, which had lower interest rates than bonds that would have been coming out in 2006, 2007 when the interest rate was higher. We see that these move in the inverse direction. The yields to maturity and the bond price move in the opposing directions. If, like what we see today, for instance, here in April of 2024, that the interest rates on newly issued bonds are rising, then the prices of existing bonds, like the one I bought in 2008, is going to fall, and vice versa. But again, this discussion doesn't matter. And it's important for you to just know this as an investor for the future. This discussion doesn't matter if you're just going to hold the bond to maturity. So my wife is in finance, and she manages a portfolio of about $75 million. And right, she gets investors, 401ks and whatnot, where they come to her and they're concerned about, they show their statement and it shows bond prices, which are low for investments they bought in 2015, 2014. And she has to tell them, dude, don't look at the value. Well, she doesn't say dude, only I would say that. But it is what I would say to the client if she were to ask me to explain it. It'd be, why are you looking at the value? If you're going to hold this instrument, this bond instrument, all the way until it matures, the price doesn't matter. Because in the year that it matures, you're just going to get back your principal payment, which would mean then that you're at 100 cents for 100 cents. The only reason why you're getting less than 100 cents today is because someone has to be compensated for the fact that they're only going to get a 2% interest rate on your bond when they could go out today and buy a 5% interest rate bond. So you need to compensate them for that difference. Shadi, what do you mean? Compensate them for that difference. That's what I mean right here, right? Is that there has to be some degree then of arbitrage. The fact that I'll buy your junky 2% interest rate bond, but I'll only do it because you're going to discount it enough. You're going to give me enough of a deal to make it so that I'm either equally well off or maybe I engage in some arbitrage, which means that I think that the markets have gotten the prices wrong a little bit. And that if the market has gotten the price wrong, I can possibly profit from this by basically buying things in one market and then selling it a little bit at a higher price somewhere else. Okay. Just want to make sure I'm not well, I guess this is important here. I shouldn't just skip over here. Okay, so let's just look at how you would read a bond table here. So for this bond table, what we'd be looking at here is that if I have a bond here which is going to mature, and I have various maturity dates. If bond A is maturing August 31st of 2023, well, I guess it'd be already matured, but I think the slides were made in 2022, so it wouldn't have matured yet. Has a coupon of 2.75. So it's paying, in this case, as you can see here, $27.50 a year for every $1,000 of face value. And so if we wanted to price out that bond, is that it's going to go out on an auction, right? And we looked at, in the previous lecture, we looked at Treasury Direct, which essentially is an auction, and we get a bid price and an ask price. The bid price would be the price that people indicate that they're willing to sell the bond for, which in this case is 104.25. And then you get the ask price, the price that buyers of bonds are saying, I would pay you 104.26. And it's pretty close, right? So the market is basically going to clear. There's going to be likely a buyer and a seller at that. And there's going to be obviously a change from the previous day. Yeah. Essentially, we could kind of just kind of go over that over time. And the only kind of comparison we can make here as well is that that our yield to maturity in this case is going to be different than the yield that we get from the coupon. So in this case, our coupon, given this coupon rate, that's paying, in this case, about what, 2.64%. So this would be, how do we get this 104.256? That would be the $1,000 times the bid price, right? And if we divide that, if that's divided by our coupon, we can solve for an interest rate of about 2.64%. The yield to maturity, 1.366. And what we can do then is compare the two. And when we compare the two, we can see that sort of yield, right? It might not be enough. Why might it not be enough? Because, right, we don't know what the future holds. What do we mean by that? We mean we don't know that the price is going to adjust in the future. So I might not be able to unload this bond for the same price that I just paid for it. And it's not, as we can see here, you can't, these two numbers are different. Why are they different? They're different because the current yield, the 2.64% that we just calculated, is ignoring what the capital gains or losses that could potentially happen in the future, as opposed to just the current yield, which is just kind of a simple calculation of what's happening right now, which is obviously completely knowable, right? Because the present, we know what's going on. It is the present. Okay. I'm going to pause right here. Sorry, trying to get it to pause. Okay, continuing on here. Sorry about that. Take a cough drop here. So if we're going to read a bond table, and we can see again this difference between the bidders, what an individual would be willing to, if we were to put this out on auction, we can see that at some points in time, there's a slight spread between the bid and the ask. That slight spread between the bid and the ask, what that does is it gives us our, essentially our profit margin, what the individual that's the dealer is going to make in the difference between the two. It's kind of in some sense the price you pay to build the market. But, we can backwards calculate what the yield is going to be based on the bid and the ask price. But what's probably more important than for comparing these different maturity bills would be the yield to maturity, which shouldn't be too surprising. The further it is out in the future, the greater the yield should be, because you'd have a little bit of a longer period of time until you get back your principal. Okay. Other things that you would see if you were looking at, instead of looking at government bonds, what would you see instead if you were looking at corporate bonds? So corporate bonds, these would be bonds that are in a secondary market, most likely. If they were in the primary market, they would be being issued by the investment bank, and then those people who bought it in the primary market would then trade it with others. So the way we would read this is, right, Apple, the company, is issuing this bond that has a 3% coupon maturing in 2027. And then what becomes important when it's a corporate bond is that you need to see what its default risk is. So its default risk here, basically anything you see in A's, it's not likely that firm is going to default. As you go to B, a little bit higher, C, basically, actually, I don't even really think, basically by the low B's, high C's, you're getting into junk territory. I think it actually only takes to, triple B minus to get to junk, I think. Sorry, I just want to see here, just because I don't think I've actually looked at. Now we call them. You could call them maybe a junk bond, but I guess a nicer term would just be it's a little bit of a higher default risk, low credit quality, commonly referred to as junk bonds. But obviously, you wouldn't probably try to hold that to maturity. You'd probably get rid of it before that point, so you'd be making more money on the interest. Yeah, so as long as once you start slipping from triple B, you start to get into junk bonds. Okay. So here, especially with AT&T, now you might be surprised by that. You'd be like, well, why does AT&T, a really big company, have a bond that's triple B? Well, could be the type of bond that it is, meaning where are they getting the money to pay off the bond? Is it secured with assets? Is it secured with, for instance, AT&T could issue bonds based on people paying their phone bills in the future. That's maybe a bit more secure than a rapidly depreciating asset. And we could kind of go through all those things. But you would want to trust then the bond rating given by Moody's and S&P, which are two of the largest bond rating agencies. Now, we'll see this later, but these bond rating agencies did play a role in the 2008-2009 crisis. If you've watched a The Big Short, the movie, that would obviously be one of the key things that played a role in the financial crisis. Is that Moody's and S&P, um, it's accused. The claim is that they mispriced rates of default and gave higher credit ratings to junkier bonds. Okay, then as we start to look at then the interest rates and the rate of return, the return, well, it's pretty easy, right? It's just the coupon payment plus eventually, the interest that you're getting plus, if you're selling it before it matures, the change in its price. The rate of return, again, if you're selling it before maturity, this is then going to be expressed as our percentage. It's going to be the amount of the coupon payment, which is essentially our interest payment, plus the change in the price of the bond, divided by the price that you actually paid for it when you did that initial price. So let's look at an example here. Sorry about that. If we wanted to look at the bond for $1,000 face value bond, meaning 1-to-1, and the coupon rate of 5%, at the end of the year, that price is $1169.84. If we wanted to calculate the rate of return, that would be our $50 that we would get as our coupon. So that's right here, right? That'd be 5% of 1,000 plus the change in the price, meaning we went from 1,000 to 1169.84. That's a difference of 169.84. So 50 plus the 169.84 divided by the purchase price, which was the face value of 1,000. It's a 22% rate of return. Pretty darn good. Now, if instead that bond that you sold at the end of the year went from 1,000 and you're again selling the bond before it reaches maturity, you sold it for $864.09, then you obviously lost money. So then it would be plus a negative capital, well, it would be plus a capital loss, which in this case is $135.91. Okay, and so I'm not. It's important to recognize here that you would actually have to sell the bond for that capital gain or loss, that rate of return, to be realized. Again, this goes back to that earlier comment I made about how some of my wife's clients get all upset because they see these unrealized capital gains or losses, especially that they see unrealized capital losses on bonds that they own. And she has to tell them you can ignore it because it's an unrealized capital loss. If the client holds that bond to maturity, they're going to get the face value back, the $1,000 in this example that we're talking about here. Bond investing is not risk-free. And that's something that if you start investing more over time, you start to learn. The risk that comes along with bond investing is first, you could, if you start to chase yield, meaning you start to chase higher interest rates, you create some default risk because you'd have to start investing in riskier things. But also, if you're buying, like, in my case, when I bought that City of Philadelphia school district bond, it was a 30-year bond. Dude, it subjected me, and I was an early investor at that point. I was just learning more. I obviously incurred significant interest rate risk, which makes it a little bit harder for me to actually sell it before maturity because I'd lose quite a bit of money. The only alternative would have been if I bought a bond that was maturing much sooner, I would have been imposed with less interest rate risk because as the future gets closer and closer, right, the time period is closer and closer, you're better able to predict it. I don't know how you predict interest rates over 30 years. I mean, we can, but just not very well. And you can kind of see this calculation here that, right, as the years to maturity spreads out, I'm paying the same yield, right? In this case, it's a fixed interest rate bond, but we're creating the fact that as the time period changes, right, and during that first year, the interest rate increased from 5% to 7%. Then look at that. If I held that bond then for 50 years, when in year one I bought it and the interest rate was 5%, so I bought the bond at the current market rate. During year one, it increased to 7%. For 50 years, if I held it to maturity, look at that capital loss in this point. Incurred by a price at year 50 that $1,000 bond is only worth $724.66. Again, incentivizes you then just to hold it to maturity. And so this is an important slide because it then just highlights again the complexity of bond investing. It's not easy because yes, even if you invest in treasury bonds, you're not going to have a default risk or very little default risk, but you have significant interest rate risk. Where did we see this? We'll look at this in later chapters here, but this is exactly what caused the banking mini crisis that we had last March, where Silicon Valley Bank failed because they bought all these treasury bonds at rather low interest rates. And even though the losses were unrealized, they were forced to account for these unrealized, very significant capital losses as interest rates went up. So, what could you say? Well, the people in Silicon Valley Bank should have remembered slide 53. Treasury bond investing, which is what banks essentially do, is not a simple job. If you buy too many long-dated bonds, you have, the potential to incur pretty significant capital losses. Okay. This last part is actually really simple, and this is our last part of this chapter here. And should be going back all the way to the beginning set of slides here, is that there's a difference between nominal and real interest rates. Again, with the difference between the two being what you expect the inflation rate to be. If we go all the way back to the earlier slides here, right, all the way back to the very beginning, we said that what the interest rate represents is compensation for inflation based on their expectations. So in the year 2000 or 2020, they were thinking that inflation rate wouldn't be so significant. So they thought that they'd be earning a real interest rate that was in fact positive. But had they known, right, in this case, let's go back to my 2.875, which is the interest rate that's being charged to me. They were expecting, so this is my nominal rate. The nominal rate meaning what I would see on my bank book, on my mortgage statement. That the real interest rate in essence reflects the nominal minus inflation. Theoretically, the bank would want this to be positive. They'd want to earn something back after inflation. And what I'm saying to you is that there's not enough space in that 2.875 rate. Let's just even say that the inflation rate right now is 5%. That's obviously a negative number. So the bank is, in this case, losing money on my... And I just looked at an earlier article and it said right now that the mortgage rate is about 7%, which you can see then, right? If we still have that 5% inflation rate, that goes back to them having a positive real interest rate. Out of that 2%, they'll need to pay the depositors and whatnot. And they have that default risk that comes out of that 2%. One of the reasons why economists then hate, well, I shouldn't say that they hate inflation. One of the things that causes part of the problem here for economists isn't inflation itself. It's that it's when the inflation becomes unexpected. And that's really kind of the narrative, the story of what we'd see over the past 3-4 years, is that at least a significant number of economists would claim that the inflation that we're seeing today is unexpected. And it causes these, I don't want to say random, but it causes these unexpected redistributions of wealth between borrowers and lenders. In this case, because the inflation was unexpected and I got this 30-year mortgage, I unexpectedly gained wealth in real terms because I'm now able to pay back a loan at 2.875% interest easier if the inflation rate is 5%, and if my wages go up at that same point. And we can kind of look at this data historically, that again, what we should see is that the nominal here should reflect the summation of the that the real interest rate, the red, should equal the difference between the nominal interest rate and the inflation rate. Now, if you remember what I said, that it's really difficult to make predictions of 30 years of interest rates, what you can see in this picture, what this picture is showing us, is that the reason why the United States is an anomaly, why we offer 30-year mortgages, whereas other countries don't even try to predict interest rates or inflation rates for 30 years. They just say we're going to reprice it every 5 years. The reason why we do that, one of the reasons, would be because, at least according to this, is that forecasting interest rates, inflation rate in the United States has been a lot easier since the Greenspan administration, when he was Federal Reserve Chairman in 1987, because the Federal Reserve does a pretty good job of managing that inflation rate to around 2%. And then you can see here, I had like the 2008-2009 financial crisis, and then the increase that started happening in 2015 under the Janet Yellen administration, at least in the data that goes out to 2020, economists did a pretty good job of predicting what the real interest rate was going to be. And again, what I'm arguing to you here is that at least for the beginning of COVID, is that the red line got really, really negative, and that the orange line was somewhat higher than that, like this right here. That obviously the bank wasn't expecting to get a negative real interest rate, but they unexpectedly did. Okay, that's it for this chapter. This chapter took a lot. This took almost an hour and 40 minutes to cover this, but hopefully at my slow, deliberate pace, interest rates now and the rates of return make a little bit more sense.